They never ring a bell when smart money makes its move. There is no breaking news alert, no screaming headline, no sudden rush that feels obvious in the moment. The preparation happens quietly, patiently, sometimes years before the crowd even realizes something is changing. And that silence is exactly why most people miss it. Because when silver finally moves, when it stops drifting and starts behaving like an asset everyone suddenly wants, the preparation phase is already over. The positions are already built. The supply is already spoken for. The rules of the game have already shifted. Smart money does not chase price. It studies pressure. It watches strain build inside systems that look stable on the surface but are cracking underneath. Silver is one of those systems. It is not just a metal. It is a bridge between finance and reality, between paper promises and physical necessity, between what markets say something is worth and what the world actually needs it for. And that is where the preparation begins. The first thing smart money watches is not charts. It watches behavior. Specifically, it watches how silver behaves when everything else is supposed to be calm, when inflation is called transitory, when interest rates are presented as under control, when growth projections sound confident and orderly. During those moments, silver often refuses to cooperate. It stays stubborn. It does not crash the way it should. It does not rally the way hype traders want. It just sits there, absorbing pressure, telling a quiet story that most people are not trained to hear. That story is about demand that does not go away. Silver is not just hoarded. It is consumed. Solar panels, medical equipment, electronics, military systems, energy infrastructure. These are not optional industries. They do not slow down just because markets want them to. And every ounce of silver used industrially is an ounce that does not come back easily. Smart money pays attention to that asymmetry. Gold is hoarded and recycled. Silver is used and lost. Over time, that difference matters more than headlines ever will. Another thing smart money tracks closely is the disconnect between paper silver and physical silver. Most people think silver has one price. It does not. There is the traded price, driven by contracts, leverage, and algorithms. And then there is the real price, revealed during stress. The price you pay when supply tightens, when delivery delays appear, when premiums rise quietly, while the so-called spot price pretends nothing is happening. Smart money has seen this movie before. It understands that paper abundance can hide physical scarcity for a long time, until it suddenly cannot. Preparation also means understanding cycles, not in years, but in psychology. Silver is notorious for frustrating investors. Long periods of boredom followed by explosive moves that feel almost violent. This is not an accident. It is how weak hands are shaken out. It is how patience is punished before it is rewarded. Smart money accepts this. It builds positions slowly during periods when silver feels forgotten, mocked, or dismissed as dead money. That emotional environment is not a warning sign for them. It is the entry signal. They also pay attention to who is not selling. When price drops but supply does not flood the market, that tells you something. When miners hesitate to expand production despite higher demand projections, that tells you something else. Mining silver is not easy. Grades are declining. Costs are rising. Environmental and political risks are increasing. Smart money looks at these constraints and understands that future supply is not as flexible as markets pretend it is. Another layer of preparation happens through diversification of exposure. Smart money rarely bets in one way. It may hold physical silver quietly, outside the system. It may hold selective miners with strong balance sheets. It may use long-dated positions that benefit from volatility rather than short-term price spikes. What matters is optionality, being positioned for multiple outcomes while the crowd is all leaning in the same direction. And then there is the macro picture. Currency debasement is not a theory. It is a policy tool. Governments choose it because it is politically easier than austerity. Over time, this erodes trust, not all at once, but gradually. Smart money does not wait for a crisis announcement to respond. It watches debt curves. It watches deficits normalized as permanent. It watches how often emergency language becomes routine. Silver thrives not in panic alone, but in long periods of quiet monetary erosion. This is why preparation happens when silver looks boring, because boredom is cover. It allows accumulation without competition. It allows mistakes to be corrected quietly. It allows positions to be sized properly, without emotion. When silver finally breaks out, the narrative always changes overnight. Suddenly there are explanations. Suddenly there are experts. Suddenly it all makes sense in hindsight. But the preparation never happens in hindsight. It happens in discomfort. Smart money also understands time differently. It does not need silver to move tomorrow. It needs the conditions that make movement inevitable. It watches energy transitions that require massive silver inputs. It watches geopolitical fragmentation that stresses supply chains. It watches trust decay in institutions that once anchored confidence. Each of these trends alone is manageable. Together, they create pressure. And silver is extremely sensitive to pressure. Another subtle signal is how central banks talk without talking. They rarely mention silver directly. But when they emphasize resilience, stability, and confidence repeatedly, it often signals the opposite. Smart money listens to tone, not words. It understands that credibility is most loudly defended when it is quietly weakening. In those environments, tangible assets with industrial utility and monetary history become increasingly attractive. There is also an understanding that silver does not need perfection. It does not need a global collapse. It does not need hyperinflation tomorrow. It just needs continued strain, continued demand, continued underinvestment, continued belief that nothing is wrong. Smart money thrives in those gaps between perception and reality. The preparation phase is about patience, positioning, and humility, knowing that timing exact tops and bottoms is a fool's game, knowing that being early feels the same as being wrong for a long time. Smart money accepts this trade-off because it understands payoff asymmetry. Downside is limited to boredom and volatility. Upside is violent repricing when scarcity becomes visible, and when that moment arrives, it never feels orderly. Silver does not climb politely. It jumps. It gaps. It triggers margin stress. It exposes leverage. It forces repricing across connected markets. By the time most people feel confident buying silver, the easy part is already gone. So preparation looks boring from the outside. It looks slow. It looks unnecessary. It looks like nothing is happening. But beneath that stillness, positions are being built. Supply is being absorbed. Optionality is being stacked. And when the move finally comes, it will not ask for permission. Because this is how smart money prepares for silver moves. Not by predicting the day. Not by chasing excitement. But by understanding pressure, respecting cycles, and positioning quietly, while everyone else is waiting for a signal that only appears after the opportunity has already passed. That opportunity always feels obvious only after the fact. Before that, it feels uncomfortable. It feels like holding something that refuses to perform on command. And that discomfort is not a flaw in the silver market. It is the filter. Smart money understands that markets are designed to reward patience disguised as pain. Silver is one of the best examples of this design in action. One of the quiet signals smart money watches is volatility compression. Long periods where silver trades in a narrow range, frustrating both bulls and bears, are not random. They are pressure chambers. Energy builds when an asset is repeatedly suppressed by short-term forces while long-term fundamentals continue tightening underneath. Smart money does not ask when it will break. It asks how much pressure is being stored. Because when release happens, it is rarely gentle. Another thing that separates smart money from the crowd is how it interprets bad news. When silver sells off on headlines that should already be priced in, that tells you sellers are running out of conviction. When negative narratives fail to push price meaningfully lower, that is not weakness. That is absorption. Someone is on the other side of those trades, quietly taking inventory without advertising it. Smart money also understands that silver is not a clean story. It does not move in straight lines. It does not respect neat timelines. It is influenced by interest rates, currency strength, industrial demand, speculative flows, and psychology all at once. This complexity turns off most investors. They want clean narratives. Silver refuses to provide them, and that refusal creates mispricing. Preparation means embracing that complexity instead of fighting it. It means accepting that silver can fall even when fundamentals improve, because positioning matters. It means knowing that short-term price action can be dominated by paper leverage that has nothing to do with real-world supply. Smart money separates signal from noise by asking one simple question over and over again. Has the underlying reality changed? If the answer is no, then volatility is not a threat, it is a feature. Another subtle aspect of preparation is liquidity planning. Smart money does not allocate to silver with money it might need next month. It uses capital that can sit through storms. This is critical because silver tests conviction. Sharp drops happen quickly. Rallies happen faster. If you are forced to react emotionally, you are already playing the wrong game. Smart money structures its exposure so that it does not have to make decisions under stress. There is also an awareness of correlation risk. In moments of market panic, everything can sell off together, silver included. This confuses people who expect it to behave as a perfect hedge at all times. Smart money understands that initial liquidity shocks hit everything. What matters is what recovers first and what recovers strongest. Historically, assets tied to real utility and scarcity tend to reassert themselves once forced selling ends. Preparation is about surviving the shock so you can benefit from the recovery. Another important behavior smart money watches is retail sentiment. When silver forums are quiet, when mainstream coverage ignores it, when the loudest voices declare it irrelevant in a modern digital world, those are not bearish signs. They are early signs. Smart money prefers assets that are under-owned, under-discussed, and underestimated. Silver checks all three boxes more often than most people realize. Smart money also pays attention to how governments and institutions respond to rising costs. When inflation pressures appear, the instinct is always to manage perception first. Statistical adjustments, redefinitions, temporary explanations. Over time, this erodes trust. Silver does not require trust. It requires physics. It conducts electricity. It reflects light. It heals wounds. It does not care about narratives. That makes it uniquely positioned in a world increasingly dependent on technology and increasingly skeptical of promises. Preparation also involves studying history, not to repeat it exactly, but to recognize rhymes. Silver has spent long periods suppressed relative to gold, only to violently catch up when conditions align. These catch-up phases are not linear. They are sudden, and they are often dismissed as anomalies until they are undeniable. Smart money studies these patterns not to predict exact dates, but to understand scale. How far silver can move when it finally stops being ignored. Another often overlooked factor is inventory transparency. Silver inventories are reported, estimated, revised, and reclassified constantly. Smart money knows these numbers are imperfect. What matters is trend and stress. Delays, backwardation, rising premiums. These are the whispers before the shout. By the time headlines acknowledge shortage, positioning opportunities are gone. And then there is the psychological preparation. Smart money knows that when silver finally moves, it will feel chaotic. There will be calls to take profits too early. There will be sharp pullbacks designed to scare late buyers. There will be confident voices explaining why the move is over after every dip. Preparation means having a plan before emotion takes over, knowing what conditions would actually invalidate the thesis, rather than reacting to noise. This is why smart money does not obsess over daily price ticks. It obsesses over structure, supply chains, energy policy, monetary credibility, industrial demand curves. These forces move slowly, then all at once. Silver sits at the intersection of all of them. And as those pressures continue to build, as preparation quietly continues in the background, silver remains exactly where smart money wants it to be. Unloved, underestimated, and loaded with potential energy that does not announce itself until it is impossible to ignore. Impossible to ignore does not mean easy to endure. When silver finally begins to assert itself, it does not reward impatience. It exposes it. Smart money knows that the most dangerous moment is not the bottom. It is the transition from disbelief to curiosity. That is where mistakes multiply. That is where people size up too late, chase confirmation, and confuse momentum with understanding. By the time silver starts moving in a way that feels convincing, the groundwork has already been laid. Physical supply has already tightened. Long-term positions are already in place. Industrial buyers are already locked in. What remains is repricing. And repricing is never smooth, because it forces a re-evaluation of assumptions people were comfortable with for years. One of those assumptions is that silver is abundant. It is not. It is widely dispersed, often produced as a byproduct, and increasingly difficult to extract economically. Smart money understands that byproduct metals are uniquely vulnerable. When base metal demand slows, silver supply slows with it. Regardless of silver, demand. This creates a delayed shock that markets are terrible at pricing ahead of time. Preparation means seeing that lag before it becomes obvious. Another assumption is that technology reduces material dependency. In reality, it often increases it. The more advanced systems become, the more they rely on precise, high conductivity materials. Silver is not easily substituted without trade-offs. Smart money looks at electrification trends, defense modernization, medical expansion, and understands that silver demand is structural, not cyclical. That changes how risk is calculated. Smart money also prepares mentally for volatility amplification. Silver is a smaller market than gold. That means flows matter more. When capital reallocates even modestly, price impact can be disproportionate. This is why silver rallies tend to feel exaggerated. They are not irrational. They are mechanical. Thin markets reprice faster. Preparation means being comfortable with sharp moves in both directions, without mistaking volatility for failure. Another key distinction is how smart money treats narratives during the move. When silver rises, explanations will flood in. Some will credit inflation, others geopolitics, others renewable energy. Smart money does not marry any single story. It understands that narratives are retrofitted to price. What matters is that multiple forces are aligning in the same direction. That alignment is rare. When it happens, it tends to persist longer than people expect. There is also an exit misconception. Smart money does not plan exits based on price targets alone. It watches behavior again. It watches when silver becomes trendy, when mainstream media frames it as obvious, when leverage floods in, when volatility spikes without corresponding fundamental change. Those are the warning signs. Preparation includes knowing when enthusiasm replaces insight. Another often ignored element is regulatory response. When assets move violently, authorities respond. Margin requirements change. Trading rules tighten. Narratives shift from curiosity to concern. Smart money anticipates this. It avoids structures that are fragile under rule changes. It favors simplicity and resilience over cleverness. Because clever strategies break when rules change. Simple ones endure. Preparation also means understanding personal psychology. Silver will test it. There will be moments when doing nothing feels unbearable. Moments when selling feels smart. Moments when holding feels foolish. Smart money accepts these moments as part of the process. It does not seek emotional comfort from the market. It seeks alignment with reality. And reality is this. Silver sits at the crossroads of energy, technology, and trust. It is not dependent on a single outcome. It benefits from multiple stress paths. Inflationary pressure, supply disruption, industrial expansion, monetary skepticism. It does not need all of them at once. It only needs enough of them to strain the system. That is why smart money prepares quietly. It does not announce its thesis. It does not evangelize. It positions, waits, and adjusts as reality unfolds. It knows that the biggest gains are made before conviction becomes popular. When silver finally forces attention, it will feel sudden. People will say it came out of nowhere. But it did not. It came out of preparation. Years of it. From those who understood that markets do not reward those who are loud, fast, or confident. They reward those who are early, patient, and aligned with forces bigger than headlines. And that is the final truth about how smart money prepares for silver moves. It does not try to outsmart the market. It lets the market reveal itself in time. And when it does, the work is already done.